This video is sponsored by Playbook. More about them later in the video. And in case we haven't met, welcome. If you're new to the channel, my name is Tay from Financial Tortoise, where we learn to grow our wealth slow and steady. The number one truth about stock market volatility. Market volatility is normal. When it comes to investing in the market, understand that market volatility is a very normal fact of life. The stock market at various times experiences sharp, unpredictable price movements, both up and down. A slide of 10% or more in the market index, like the S&P 500, is considered a market correction. A decline of 20% or more is considered a bear market. On the flip side, an increase of 20% or more after a bear market is known as a bull market. And because we're human, when we see the stock market move up and down, it's natural to feel a bit anxious, especially if we have a sizable amount of money invested in the market. Should I sell? Should I hold? Or should I buy more? The market seems so shaky. 1 minute it's up, the next minute it's down. What to do? Well, if you're having these thoughts, do not worry. You're not alone. It's natural to have an emotional reaction to seeing our portfolio take a huge dive because this is real money we're talking about. And I'm sure panicked headlines don't help either. However, understand that market volatility is very normal. If you're invested in the stock market volatility is normal and expected. You'll continue to see your portfolio surge up one day and plummet the next. It's an expected occurrence. However, still uneasy about market volatility, especially when news headlines are screaming it's the end of the world? Well, let's get into the next truth. Truth number 2 about market volatility. Perspective is important. Often when we put it into perspective, it's not as crazy as the media makes it out to be. Whenever the stock market dips, the news headline loves to make it seem like it's the end of the world. The biggest dip ever. The market is crashing. Investors be aware. Or the other way around. The market is overpriced. It's inflated. However, before you decide to panic sell all your shares, put it into perspective. Pay close attention to what the quoted change really means. The financial media loves to quote changes to market indices. The Dow Jones closes higher by more than 400 points. The Dow drops more than 600 points. And when we hear big numbers like this, 400, 600, it's easy to think, oh my goodness, the market is so hot right now. Am I overpaying to invest in the market? Or oh no, the market is crashing. Should I pull all my money out? However, when we pause and actually do the math, we realize that the change is not as crazy as the media makes it out to be. With the Dow Jones at around 38,000, 400 and 600 points represent about plus or minus 1% change. So next time you hear or read some news piece about how the market is going crazy, put it in perspective. It may not be as bad as the media makes it out to be. But since you're a curious individual, you might still be thinking, even with the small upticks or downturns, you still want to know why is this happening. What's driving the short-term market volatility? Which leads to a next truth. But before we go on, a word from our video sponsor, Playbook. There are a lot of things you cannot control about the stock market. However, do you know what you can control? How you can leverage tax codes to optimize your investments. And if you're scratching your head as to how, well, Playbook can help. Playbook is a step-by-step app for growing your money the smart way. It uses state-of-the-art strategies to find missed opportunities, calculate your optimal tax strategy, and accelerate your path to financial freedom. There are a lot of ways to pay less in taxes and grow your money the smart way, made possible by tax advantage accounts like 401ks, IRAs, and Roth IRAs. However, these tax opportunities don't remain open forever. They expire every year. If you delay filling these accounts even by just 1 year, you miss out on decades of compound interest, the true power to wealth building. But understanding what accounts to open and to fill in what order can be tricky, because let's be honest, tax codes aren't the easiest to understand. Also, your financial situation is unique to your life circumstances. This is where, in my opinion, Playbook really shines. When you open up an account with Playbook and input your financial data, it will automatically calculate your personalized optimal tax strategy, what tax advantage accounts you should fill, and in what order. And if you want to take it up a notch, Playbook can even handle the contribution for you. And unlike high-priced financial advisors who will often charge you quite a bit for this service, Playbook offers this tax optimization strategy for you starting at only $9 a month. They don't charge an AUM fee, asset under management, and they work to leverage the most advanced technology to bring you this service. So if you want to really maximize your tax savings, check out Playbook today by going to my special link, helloplaybook.com/takekim, or click the link in the video description below. Alright, with that said, let's get back to the video. Truth number 3 about market volatility. There usually is a reason for the volatility. Volatility in the stock market can sometimes feel like it's happening without any reason. But when we dig further, usually there is some driver. A sudden economic news, a company quarterly report, a geopolitical event, or even a change in monetary policy. And these news often lead to a general emotions of fear or greed. A sudden geopolitical event? People fear how it could negatively impact the economy, Thus, many sell their shares and this leads to a drop in the market. News of an innovative AI-driven gadget that could revolutionize the industry, greed, and the fear of missing out drive many to buy more shares, and thus wild price swings and potentially a bubble. However, despite there being a reason for volatility, it doesn't mean it's predictable, which leads to a next truth. Truth number 4 about market volatility. Short-term volatility is unpredictable. Yes, in hindsight after the event, we can all point to the reason why the market shot up or crashed down, why a certain company's stock surged up suddenly or fell to its death. However, understanding why afterwards does not mean we knew it was going to happen. In the March of 2020, the stock market saw one of the most dramatic stock market crashes when the Dow Jones plunged by 6,400 points. This is roughly 26% over a period of 4 trading days. The crash was caused by the government's reaction to COVID-19, which was quickly spreading around the world at the time. Governments were panicking, businesses were closing doors literally midday, and unemployment reached as high as 20%. We all hear the story and think, yes, that makes perfect sense. I totally saw that coming. Of course, the market would have crashed with the COVID spreading. However, did we? Do we really know that the market was going to react the way it did? Yes, there's a clear reason for why the market crashed, but the truth is that none of us could have predicted how the market would have reacted. Truth number 5 about market volatility. Not only is short-term market volatility unpredictable, expected to swing both ways. A company's stock and the market as a whole can move higher just as fast as it can move lower. In 2023, everyone was predicting that we were going to have a recession in 2024. Many economists spent the early 2023 predicting a painful downturn. Inflation has spiked to the highest level in decades, and many thought that a drop of consumer demand and an increase in unemployment would be needed to bring it down. However, what happened? They were proven completely wrong. The stock market surged out the gate in 2024, setting 22 record highs in 3 months. Unemployment continued to remain at a historic low. Consumers continued to spend like there is no tomorrow, and inflation retreated regardless of low unemployment and high consumer spend. So what does this mean? It means just as the market can quickly dip like it did during the COVID crisis, it can also surge forward and up like it did at the start of 2024. And none of us can predict how and when it will happen. So then what, you might be thinking? If market swings are unpredictable, what can we do? What can we do with our money? But a quick reminder before we move on to next truth. Make sure to download your free 1-page PDF companion guide that goes along with this video. Everything I'm covering here in a simple to digest 1-page format. So go to the link I'll have in the description below to download your free copy. Truth number 6 about market volatility. Yes, in the short term, in a period of a day, week, or months, or even a year, it's hard to know what the market is going to do. However, if we were to take a broader perspective, we see that the long-term trend of the market is up and to the right. Take a look at any chart of the US stock market in the past 100 years, 50 years, or even the past 20 years. The stock market always went up over a long period of time. And there's a good reason why. This is because while short-term market movement is driven by emotion, the long-term market movement is driven by fundamentals. Despite all the crazy events that happened the past 100 years, multiple wars, multiple recessions, crazy scandals, companies kept making money and the economy kept growing. The stock market represents a group of America's largest and most profitable companies: Apple, Google, Walmart, Costco, General Electric. The goods that these companies make and the services that they provide make our modern world run. People use what they create on a daily basis and happily turn over their money to buy their services and products, thus contributing to these companies' healthy profit. Yes, will some of these companies struggle and go bankrupt? Of course. Many have, and many more will in the future. But the beauty of the stock market as a whole is that new companies will come and take their place, creating better products and bigger profits. Therefore, unless the world comes to an end, there is a good chance that the market 20 years from now will be higher than it is today. Truth number 7 about market volatility. Glass is half full. Whenever there's a market downturn or a company's stock plummets, we hear about it. News channels constantly discuss how our economy is struggling and the end of modern commerce is right around the corner. Thus, it's easy to believe that there are more times a market is struggling than not. However, when we look at the data, that is not true at all. In actuality, the market has been positive more often than not. Again, if you were to look at the stock market returns by year over the past 100 years, you notice there are way more years when the stock market had positive returns versus negative. The media loves to highlight market declines because that is what garners attention. Thus, many news media follows the decade-old mantra, if it bleeds, it leads. Death and destruction attracts more readers and viewers than a boring story about how the market had averaged positive returns this year. Thus, next time you hear doom and gloom news about the market, understand in the big picture, the glass is half full, not half empty. Actually, more than half full. Truth number 8 about market volatility. Volatility is how you make money in the market. Volatility is a double-edged sword. People fear it because it can lead to losses in the short term. However, it is how the stock market produces high expected returns over time because it also presents opportunities for gains. Let's say that you fear volatility, so you pull your money out whenever the stock market bottoms out. In those cases, you're actually missing out on the rebound when the stocks have their best performance. According to a JP Morgan study, in the past years, if you stayed fully invested, riding out all the ups and downs of the market, your annualized return will be around 9.4%. However, if you were to have missed just 10 best days in the last 20 years, your annualized return drops to 5.2%. That is more than 4% in returns you're missing out. Now, how about if you missed the 20 best days? Your return drops to 2.5%. And 30 days? Effectively, no returns at 0.32%. Like life, good days happen because there are contrasting bad days. These days with the best returns happen because we have contrasting market dips. And you can only take advantage of these best trading days if you're doing these two things. 1. Buying consistently, and 2. Staying invested. If the stock market did not have volatility, it would have bond-like returns, flat with minimal ups and downs. If you want no risk in your portfolio, you would essentially invest all your money in treasury bonds. But long-term treasury bonds only offer 3 to 4% returns, while the stock market has had a long-term return much higher than that. Of course, nobody wants to see their investments go down in value, but we must remember that short-term stock prices are not a reflection of the value of the underlying company, but rather a reflection of investor sentiment at any given moment. If you take no risk, the financial market will not reward you with high expected returns. So if you want to make money in the market in the long run, embrace volatility. Truth number 9 about market volatility. So if volatility makes you money, how to take full advantage of it? By staying the course. Just like the world's best workout plan won't help us get jacked if we don't follow it, the best investment plan won't build wealth if we don't stick to it. As I talk about in this channel often, I firmly believe that the best investment strategy for normal commoners like us is to stick to a simple, broad market index fund. Invest in a simple index fund that tracks the market as a whole at rock bottom costs and hold it as long as possible. Think index funds like the Vanguard Total Stock Market Index Fund, aka VTSAX, Fidelity Total Market Index Fund, aka FSKAX, Schwab Total Stock Market Index Fund, aka SWTSX. However, this investment strategy will not work if you're constantly dancing in and out of the market because you fear market volatility. Stay the course. No matter what happens, stick to your program. I've said stay the course 1,000 times and I mean it every time. It is the most important single piece of investment wisdom I can give to you. Truth number 10 about market volatility. But let's say that after all that we went over, you're still uncomfortable about volatility. You have a hard time managing your emotions whenever you see the market go up and down. Then what? Well, there's actually a simple solution. Reduce your portfolio volatility by holding more bonds. Bonds don't have all the volatility that comes with stocks, so they're a good tool to help smooth out your ride. Yes, you'll need to accept lower overall returns, but if less volatility will help you sleep better at night and stay on the course, that might be the ideal solution for you. Here's a sample of how this can look. Let's say your main growth driver is a total stock market index fund like a Vanguard Total Stock Market Index Fund, aka VTSAX. But you don't like all the volatility. We'll add a bit of bond like a Vanguard Total Bond Market Index Fund, aka VBTLX, to smooth out your ride. VBTLX holds over 10,000 varying bonds such as US Treasuries, mortgage-backed securities of all maturities, short, intermediate, and long-term issues. With this one single bond fund, you not only get a broad exposure to the US investment-grade bond market, reduce your overall portfolio volatility. There is no one right percentage allocation, just one that works for you. But a general rule of thumb is if you want a smoother, less volatile ride, just ramp up the percentage of the bond index fund. But if you're comfortable with the level of volatility, add more stock index fund. And play around with the allocation until you find the one that works for you. Thank you guys for watching. In the line of ramping up or ramping down fund allocation, if you want to learn more about one of my favorite investment portfolio strategy, the 2-fund strategy, please check out my video here. Until next time, all the best.